Roy, first off, really thank you for your time and being here. Really appreciate you for that. So I want to start with that.
All right.
Before you got into wealth management and just helping people retire properly and that line of work with finances, what did you do prior to that?
Yeah, so I was in the military. I was an armor officer, so tanks. I was in Desert Storm. I spent 20 years active duty and 24 and a half overall with the time I was in the reserves before I went on active duty as a private and then also as a cadet and then eventually a lieutenant while in the reserves before going on active duty. So went to San Jose State University, got my commission, and then 20 years of active duty service, serving assignments all over the world.
What did you learn from your time being enlisted that translated to what you're doing in your line of work now?
I think as an enlisted soldier, you're having to do a lot of the things that you don't want to do, right? I mean, you're getting tasks, assignments that kind of test your character as far as, okay, I can follow an order, but I'm also disciplined enough to take that order and follow that order because it's part of my duties, right? But as far as how that translates, I think it just instills discipline. A lot of times when you're younger, you don't have that discipline to do things that you don't really want to do. But in that environment, in that type of situation, and at that rank, you're kind of forced to do it or face the consequences of what's going to happen to you if you don't. So
Right.
It wasn't out of fear. It was just being a good soldier and being disciplined to do the right thing. And that's what's carried over into my career now as I deal with clients is you're just trying to do the right thing for people.
High integrity. Yeah.
Yeah, high integrity. I mean, I don't even think about that because to me, it's just it's my nature and my
Right.
part of my demeanor and my character to make sure that you do the right thing.
Right. Right. I played sports growing up, so it's a good sandbox. Like I know a great deal of how being in something like a unit of some sort or a team can help build character. I think sports, military, it's some of the best training grounds for that.
Yeah, absolutely. I did
So
a little bit of sports when I was in junior high, high school, not in college, but I was very athletic growing up until everybody outgrew me. So just didn't grow fast enough for all those sports that I wanted to be in. Love playing basketball, but yeah, team sports, all that helps build your character for sure.
absolutely. Now, you have a company. I think the most important thing we're just discussing off the get here, but say someone's listening, they have no idea what you do yet, first time coming across you. Explain a little bit about what you do now in your line of work and what Journey Wealth is and your entire company at large.
Yeah, so we help pre-retirees and retirees plan for retirement. Retirement is such a big word, and it's often a very confusing area because most people don't have a comprehensive plan. And I say that because they have a bunch of little things that they've accumulated throughout life, but they don't really have a plan. So I try to take and analyze their overall situation, covering 5 main areas when it comes to your taxes, your investments, your health, your estate plan, and your income. All those tie together. But most of your investment advisors out there, if they're dealing with investments, they're really only dealing with the market. And that's what a lot of people think retirement is. Oh, it's my retirement account that I've saved up. But that's just 1/5 of the pie, per se. So you don't cover those other areas that I just mentioned, any areas that are weak, where you have a unfortunate circumstance that causes an issue and you're not covered, it can totally devastate everything that you've done. So you have to have it all working together.
Mm. That's really helpful actually to hear. 'Cause now my one thing that my mind goes to is wealth, like just the word wealth.
Mm-hmm.
What is define that for someone who's never really researched it themselves, or maybe know what it means, but actually it's the wrong meaning. How would you define that for a client?
Yeah, I mean, when you're dealing with wealth, I mean, you have sources of income that are either passive or permanent sources of income. But if you don't have sources of income in retirement, then you're going to be continually working, right? So most people only have Social Security, and even then, some people don't even qualify for Social Security, right? If they haven't worked enough credit hours to qualify. But most people have Social Security, but your average person in America only earns $2,000 a month in Social Security. So $24,000 for a year, you're talking poverty level, right? And you can barely get by on that, especially in today's environment. So you need other sources of income. So you have to build up your wealth. But wealth could be through many different asset classes, whether it be real estate, could even be in crypto, could be in the market, could be in annuities, could be in life insurance, could be from an inheritance that you received. So all those things are going to create wealth. Well, if you don't build that up, or you don't have a plan of accumulating it, and you think you're just going to hit a home run at the end and wait until the end, it could be a big problem. So it concerns me for the younger generation, your generation, actually, and my kids. I think a lot of people have just given up almost, and that's why
Why do you think? Why do you think that is?
I think they've given up because what used to be affordable, like a home, your average family could afford a home and live a decent life with their home, working the job, and it was one parent working, and then it went to two parents working. And so my generation had both parents working, no parents at home, right? And so that's why you have the boomer generation that's a lot more materialistic, because we didn't have a lot. And then as we accumulated money, they feel they need to go on every vacation there is. The younger generation is more frugal because they've seen what's happened, and they're less materialistic, but they feel they can take vacations a lot earlier than they should be, right? Because they see social media. So social media has really changed the psyche of what, the overnight millionaire. And so the younger generation thinks, oh, I can just make it by doing some TikTok video, or I'm going to do something online I don't have to really go work hard. So there's that whole issue that could be a concern or an issue for the next generation. And every older generation thinks the latter generations are always screwed up, right? You've always heard that. You always bash the younger generation, but I think there's a lot of opportunities for sure. It's just that your boomers and your generation, what is it, Generation X, Gen X,
Mm-hmm.
they're more used to working 9 to 5, earn enough so you can take that vacation. If you don't have that money, you're not taking the vacation. But that's not always the case today. So I just have a concern that the youth are not going to be putting their money and saving it enough, because they just feel it's not going to be enough. So I'm just going to enjoy life today, which is very. So I try to instill in my own kids who are, my son's 27 years old. Daughters are in their low 30s, but they're savers as well. And you need to start saving regardless. But I'm dealing with pre-retirees and retirees, and some have saved and some have not, to the extent that they should have. So, but wealth, that was a large, it's a big word. It comes in many different forms, but you have to generate some wealth, and you have to generate income streams of some type. If not, you're going to discontinue to work forever. So
now, that's very helpful. Now, you say you have a retiree, not ideal positioning. What would you do being their advisor to make a strategy so they can be comfortable even though they didn't position themselves in the best way?
Yeah. So what happens with most is by the time you reach retirement age, whether you're in your mid 60s or somewhere even in the early 60s trying to retire, most of everything that they've accumulated is in the market. So stocks, bonds, mutual funds. But all those that I just mentioned are at risk. So their portfolio is really out of whack, where they have way too much at risk. So if you have another crash, like we did in 2000, 2008, or even 2022, they don't have time to recover from that. So you could totally devastate your entire retirement because you had too much risk at the exact wrong time, right?
Right, where someone younger might have time to recuperate if they stay in the
Yes, you can
game.
take on more risk, and you can even buy low dollar cost average, all
Right.
those things, especially at your age, right? You want to take advantage of these big dips because you see things dip. That's when you want to buy. But as you get older, you don't have time to do that. So the portfolio needs to shift to investments that give you more security. That's where your fixed instruments come in, whether it be annuities, fixed indexed annuities. And you'll hear that term a lot for retirees because that gives them guarantees, it gives them guaranteed income streams, and you can't outlive the money. So if it's positioned properly, it's going to provide an income stream for the rest of their life. But if you have everything in any one category, you're either earning too low of a return or you have too much risk. You have to have a balance. So let me just show you something real quick in the back of my.
Yeah, please.
I always show this.
Oh, look at that.
Yeah. So this board, I'm always showing it because you basically only have 3 spots to put your money: red, blue, and green. So your blue is your checking, savings, money market, CDs, fixed annuities, but you're getting outpaced by inflation, right? Your red line is your stocks, bonds, and mutual funds. You can make the returns, but you can also lose, 20, 30, 40, 50% in a year or two, and it happens very quick. And then you have that green line that I just showed you that only goes up and doesn't go down. I'm a true believer that you need to have all 3. So I help people reposition and allocate their monies, and you can even use a simple rule of 100, where you take 100 minus your age. So if you're 30 years old, well, 100 minus 30, 30% of your money should be safe, 70% could be at risk. But if you're 70, 70% of your money should be safe, 30% should be at risk. So it flips, right? But what happens is most people entering retirement, because you're putting your money in a 401k or 403b, TSP, all those instruments that are used through your employers, those are all in the red line, the market. They're all at risk. So the portfolio is totally upside down. In fact, a client just stepped out just now. They had their portfolio is about 1.1 million, but all but $57,500 was at risk. The 57,500 was the checking savings. The rest was all in the market. So what happens tomorrow if the market drops by 30, 40, 50%? There goes the retirement.
Right.
Yeah.
Right.
So
Yeah, that's a great example. Totally makes sense. I would love after to get a screenshot of that. I can have the graph displayed when I do the edits when you talk, because that's really
in fact,
helpful.
I'll send you the file so you can just put the file up.
Yeah, exactly right.
Yeah.
Now, say I give a use case here. Say not 100K. Say someone has $250,000. Just hypothetical situation. They have that amount of money. What would you do with that money? Say the person is 35, maybe 40 years old. They have 250K, hypothetical situation. Where would you deploy those funds? In what way?
So I still have to collect a lot more information.
Right.
Yeah. Yeah. It's way too vague
Right.
With that, and I
Because you
know
need
your
their health and all the 5 facets.
health, whether or not you have kids, whether or not you're married, because you said single, right? Single
Hey,
250.
yeah, let's say single 250, good steady income, salary of over 6 figures, say like 100K a year. Um, they are renting still. Little to no debt. Yeah. What would that person do? And again, I know you still need more information even then, but like
Did you
just in
just
terms of
describe
how.
did you just describe yourself?
No, 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 no. It made it seem like it. No, no.
All right. Again, start with that rule of 100. So
Yeah.
35% of your money should be safe. You should have an emergency fund. So you got your emergency fund, you got your midterm goal monies that you might be needing for a home, purchase of a car, whatever that might be in the shorter 5 to 10 year range, and then you have your further out, so 10 plus years. The monies that you can deploy and hold on through retirement, those are funds that can be done a little bit more aggressively if needed because of your age, right?
Right.
But it also, part of that money could be the safe money that you just want growing safely and you're not going to touch until retirement. So it just depends on your risk tolerance, using that rule of 100, but truly using that red, blue, green line to divvy up the money. So where does your crypto and your gold and commodities and all that come into play? That's where you're not wanting to put more than 5 to 10% of your money in that, just because of the risk is really high. So even though commodities are doing real well right now, gold and silver, it's gone through the roof because China is now hoarding and stocking all that up, and it's causing silver to go over $100 per ounce. And it was only in the 20s just 3 years ago, right?
Mm.
But you only want to have a smaller portion of your money in that. Same thing with crypto. You have too many people today that want to put all their money in crypto because they could have swore it was for sure going to be the best thing. But that's also tanked as of late. So is AI. So again, too much in anything is not good, is my point I'm trying to make. You need to diversify.
Right.
And that's where the diversifying between the asset classes is crucial.
Yeah, that you've helped me see, and hopefully people listening see a different perspective on diversification, because I've heard it said before, but I like the way you have it structured, and it seems like a very like well-oiled system, because you've done it for multitudes of people so far.
And I've done it a lot for younger people. It's the kids of my clients. I say kids could be 50 years old, 40 years old, right? It's their kids is probably the best way to put it. But when someone is younger, 20, 30 years old, one of the biggest tools to use, which most people they really don't understand, is life insurance. So life insurance is the most flexible of all investments. Those 5 categories that I mentioned, it covers all 5. The wealthy use life insurance as a big part of their legacy planning. They just get big policies and it passes on to the next generation tax-free, right? So I'm not talking term insurance, I'm talking permanent insurance. And that permanent insurance, which builds cash value, can be in the red, blue, or green line. And just depends on your risk tolerance. I tend to use that green line with a life policy that also has a long-term care component, so that you can accelerate it for long-term care when you need it later in life, which is a big problem most people have, is not having that need covered. And if you're trying to pay for long-term care needs in the future with your IRA, you're not getting a dollar for dollar from that IRA. You're getting 65, 70 cents on the dollar, right? Because the rest goes to Uncle Sam. But when you take it out of a policy, it's tax-free, dollar for dollar.
Right.
So imagine accelerating that death benefit that has grown over time because you were young when you started it. It could be in the millions when you're accessing it, and now you're accessing and pulling it out tax-free. So you want to have tax-free investments, either Roth or Life are your two major tax-free tools. You should have both. Like if it was your situation, like I just did for my son-in-law who's in his 30s, for my daughter, got him a life policy. He's going to be funding it each and every year. When you do the numbers on it, it projects out into the millions by the time he's in his 70s and 80s. And who knows what the cost of care is going to be at that time. Now, at a younger age, you're really not thinking about that. But trust me, time goes by very quickly. Policies compound. And if you needed to access it anytime before retirement, life insurance you can access. Roth IRAs and IRAs you can't access typically until you're 59 and a half, right? So if you need to access something, you're not going to be pulling it from the Roth without a 10% penalty from the IRS, right?
Right.
Unless it's a first-time home purchase. So life policies, you build up that cash value, you end up what's called being your own bank. So you can pull the money out tax-free, you can put the monies back in. If you don't pay it back, it just reduces the death benefit when you pass away. But now you've got this revolving amount of money that you can access. So if you need to make that purchase on your first home, you can take a big chunk out of your policy and throw it towards the home, and you pull that out tax-free.
Yeah, especially if the equity on the home builds, then that's kind of offsetting anything that is taking away from the death penalty in the policy itself, in a way.
In a way, yep, because you're making it up through the growth. That's why if you have a home, you have real estate, you have your investments, you have your life insurance, all those things are critical to have a well-rounded portfolio. You have your commodities a little bit, because again, if you have a devalued dollar, where are you going to turn to, right? And that's where right now globally, a lot of the countries don't want to use the US dollar, and they're trying to go to a digital currency. Even the US is doing that right now. All that's happening as we speak.
Right.
So, but goes back to the diversification, taxable, tax deferred, tax free. You want to be in tax free investments as much as possible. Life and Roth are your tax free. Checking, savings, money market, stocks, bonds, mutual funds are all taxable in the year that you earn it. So you're not getting tax deferral on your money. Annuities are tax deferred. So you put it into an annuity, it's not going to be taxed until you pull the money out. So you're getting deferral of your money in the compounding. So taxable, tax deferred, tax free. IRAs are also tax deferred.
Yeah, very helpful breakdown, explanation. Now, one question for you, for those listening, younger audience. Is a home ownership, especially in America, like worth it right now? I know we can't do anything about the price of the homes. Certain areas, I know some say comparative New York to New Jersey. I'm on the East Coast. New York's a little bit better, or say even go to the central part of the U.S. Texas is a little bit better for what you get on 1 acre for the price compared to New Jersey. But do you think right now, say same use case, 35-year-old, is it still ideal for them to hold out a little bit and then buy a home, or say they really needed it to just go for it and buy a home?
I would tell you to hold off right now, only because the market's still really high and it's dropping. So you have homes dropping in Texas, Florida,
Everywhere.
all the states that had a big rush of people going into are dropping the most right now. So Colorado, Arizona, and then you have even parts of the Northeast that are actually appreciating, which is kind of odd. But because so many people left the Northeast and went down south, it raised the price by a good 30%. Those prices are now coming back down because the income is not high enough to purchase the homes. So it's stretched further than it's ever been before, and it's just not affordable. So people are finally realizing that, and that's why you have a glut in the market right now. Plus the interest rates are real high. The interest rates are coming down, but again, it's not so much the interest rate, that's a big part of it, but the bigger issue is the income. to afford the home.
Mm.
And there's ratios, and I would say the ratio right now as to what it has been historically, but I can't remember the exact number, but we're at the highest it's ever been as far as where it should be, the threshold. And that's why people just can't afford it. And that's why I said the younger generations kind of just lost hope, where before, if you had a normal job, you can buy your 1,200 square foot, 3-bedroom, 2-bath home before, but now everybody wants 3,000, 4,000 square foot homes on the beach, right? So what was normal before in the 50s and 60s, it's kind of changed today. And that's where it's become a little bit just unaffordable. But to answer your question, I would wait because the interest rates are still coming down. Housing prices are still coming down. I was expecting a bigger market drop, but if you look at Florida right now, it's dropping big time. So is Texas. Texas and Florida are getting hurt the most. Plus the rising cost of insurance in certain states. Some of the insurance companies have just left, like here in California, where I'm talking to you from right now. Even insurance companies not wanting to insure in Hawaii, Florida. You have the hurricanes. The insurance is through the roof. So you buy a home and don't have it insured, and a hurricane comes through and wipes it out. Who wants to move to a place where you can't even get it insured? So that's causing part of the exodus as well.
Mm.
Yeah.
Being in Austin, I could speak on what you said with having high demand come in. They built up for it, big supply, and then a lot of people left, or there's just not as much coming in as they anticipated. So big rise, but now a little bit of a fall there.
He also had big price manipulation from your I'm not going to mention the names on this podcast, but your biggest hedge funds in investment companies gobbling up the market. So the administration's trying to put a stop to that, right? It's because the housing is meant for the people, but trying to get these corporations to stop buying it up and forcing prices up or undercutting a seller or a buyer.
Right.
Hopefully that changes things as well.
Yeah, it's very helpful. Very, very helpful. Now, want to ask something more. So for you, you have so much experience in this field of work and building your business. What's something you would have done for yourself when you were earlier? Like say, you're Roy now, looking at your 20-year-old self, you could speak to him, give him some financial advice, and kind of in a way, you'll be doing that to your children. You're doing that now. But say for yourself something you didn't do when you were in your 20s, that you wish or your older self would tell you to do.
I probably would not have sold properties that I had purchased. So the wealthy purchase homes and they keep them. And then you rent them and use property management. And then you borrow from them. So when you borrow from them, you're not paying the taxes because you're taking a loan, right? You're paying interest. So there's always the big drive to purchase a home, sell the home, use the equity to buy the other home. Whereas you could purchase the home, use the equity in the form of home equity lines of credit to purchase another home, but you still own the home, right? And now you're renting it out. So clients that I've seen, especially military clients who had moved all over the place, and everywhere they moved to, they purchased a home and they kept them. And then they rent them out. And so now they've got 5, 6 homes throughout the country, all generating income that are paid off. And it was paid off by the renters. And if they needed to borrow from those homes, they could do home equity lines of credit on those to purchase more homes. Right?
Right.
So you won't hear that from most people dealing with, as far as advisors, unless they're in the real estate field, right? But again, I'm talking holistic planning. What I've seen for people who acquire wealth, a big chunk of their portfolio is real estate. And they leverage the money. So people who don't know how to invest end up getting in more debt. The wealthy acquire assets to use the equity to purchase more assets, even though you still have debt. And they use other people's money to pay down their debt and other people's time. So other people's money, other people's time. Keep the asset, use the asset.
Right. I hear like an underlying theme of like becoming your own bank is, you know, same with life insurance where you can pull from the home equity line of credit.
From the home.
Yeah, from the home.
And
yeah,
you're
that's
not
good
getting
stuff.
that from a broker. You
Right.
just
Yeah. I really appreciate there's like holistic medicine, right? I think it's far better, far healthier than, you know, pharmaceutical or the current industry standard traditional ways of doing things. Corporations really, in a way, there's no Hippocratic oath. They're not abiding by a Hippocratic oath, which that was originally established so people did the best for the patient, whereas now a lot of people that's not around. Doctors don't do that. So with what you're describing, it's like a holistic wealth method in the industry.
yeah. So utilizing everything that's out there in different proportions for the benefits of what each provides. So I always say this, there's no bad investment. There's only bad advice. Okay. Because you could have somebody invest in something and make millions off of it and another person lose their shorts, right? Because they didn't know what they were doing.
Right.
They did it at the wrong time. It's like you asked me, should you buy a home now? No.
Yeah. Right. That makes sense.
Yeah, because if there's a correction and you built up the assets to take advantage of it, you know, that was the other thing. When the market crashed, each time it crashed, if you said, could I do something different? I was never positioned where I could take advantage of a down market. I was always a victim of the down market. Looking back, as I was raising my kids, right? And looking back, if we would have positioned things differently and not purchased at certain times and then waited, we could have taken advantage. Because there's big swings that happen. And the people who have the liquidity at the times of those events are the ones sitting well today.
Right. Yeah. They time it like a surfer. Like you go to Hawaii as well. So there's like it's like knowing how to ride waves,
Right.
tying it.
Riding the wave, you're riding with it. So.
Right. Now, more company related question, character related question. The clients that work with you say, you know, when it's all said and done, you eventually pass the business on or the business, you do whatever you want with it. When you're done, what do you want clients to have said about you? Like, what do you want people to have said about you and you're working with them?
I would want them to just give an honest assessment of how we helped to serve them, how we helped them with their retirement, that we did everything we could to maximize their assets to the ultimate extent, right, of what you can do. Yeah, our clients write reviews, and some are very heartfelt. Some are multi-generation at this point, where I've helped their parents and now them, and then, you know, their spouse has passed away. Yeah, there's a lot you can do, and if you don't have somebody there for that, it can be devastating.
Right. Love that. Good stuff. Is there anything else you'd want to add on before we wrap up here?
No, I mean, main thing is just making sure if you're going to work with someone that has a broader perspective of, I don't want to say just investments, but life, right?
Right.
So you need to have someone who does planning, because you can always find someone who sells product. Everybody sells product, but do they do any planning? Okay. So with their background, and you don't find that. So you're going to find that more so in independent practices as opposed to the wirehouses or the brokerage firms or the banks. People who have gone independent, who might have worked for a wirehouse or worked for something else, their practices have now evolved and they're now doing full comprehensive planning. So you want to find a firm that does comprehensive. Most of my peers that I know that I deal with and are with the same marketing organization that we use have various backgrounds, but they're doing the holistic approach with their clients. And that's what you want to have.
I like that. Yeah, I definitely learned many things on this conversation. I hope, but I should say more so I know people listening have as well. But yeah, I really appreciate your time. This was excellent conversation.
No, you had a lot of good questions. You notice I had big pauses in between some of those questions because they're pretty deep questions. So I didn't pause too long and answered those in the clear.
No, it was excellent.
For your viewers, but I appreciate being on. Thank you for having me on, and maybe we could do one in the future. I don't know if you want to do a different topic, but I'd love to be able to provide a source of knowledge for you.
Yeah, thank you. Yeah, I would love that. Love a part 2.
Very good. Yeah, need to do part 2.